Today we are talking about a strategy so simple, yet so powerful, it's been hailed as one of the easiest ways to get rich in the stock market. We are talking about dollar cost averaging. So grab your calculators, your notepads, and your favorite caffeinated beverage because we are about to dive into the world of systematic investing. Investing can sometimes feel like trying to navigate a ship through a storm. Markets go up, markets go down, and sometimes it seems like they're just spinning in circles. And through it all, there's that nagging question: when's the best time to invest? Enter our hero, dollar cost averaging, or DCA for short. Now, for those of you who just tilted your heads and went, dollar cost what now? Let's start with a quick definition. Dollar cost averaging is an investment strategy where you consistently invest a fixed amount of money at regular intervals, regardless of the price of the investment. Think of it like a subscription service for your investments. Just like how you'd pay a monthly fee for your Netflix or Spotify, with DCA you're setting up a regular payment into your investment account. But how does paying regularly help you get rich, you ask? Well, let's break it down with a simple example. Let's say you have $1,200 that you want to invest in a stock that's currently trading at $100 per share. Now you can invest all your money right away and get 12 shares. But what will happen if the stock's price falls to $80 next month? You'd be kicking yourself for not waiting. Instead, you decide to use DCA and invest $100 each month for a year. The stock price fluctuates throughout the year, going as high as $120 and as low as $80. But because you are investing the same amount each month, you buy more shares when the price is lower and fewer when it is high. At the end of the year, you may find that you've bought more than 12 shares for your $1,200, and your average cost per share could be lower than $100. This is the power of dollar cost averaging. It smoothens out the volatility in the price of the stock, potentially reducing the risk and increasing your returns. But don't just take my word for it. A study by Vanguard found that over 10 years, dollar cost averaging could result in an average annual return of 6.2%, compared to a lump sum investment return of 5.5%. And another study by AQR Capital Management found that DCA outperformed lump sum investing 2/3 of the time over a 10-year investment period. But let's not stop at theoretical examples. Let's take a look at a real-world scenario. Imagine you start investing in the S&P 500 in January 2000, right before the dot-com bubble burst. If you had invested a lump sum of $10,000 by the end of 2002, your investment would have shrunk to about $6,000. Ouch. But if you had used DCA and invested $278 each month for the same period, despite the market crash, you would have ended up with over $10,000 by the end of 2002. And if you had kept up with your monthly investments, by the end of 2020, you would have had over $400,000. Not bad for a $278 monthly investment, right? Now, like everything in life, DCA isn't without its critics. Some argue that if you have a lump sum to invest, you should invest it all at once. After all, the market tends to go up over time, so the sooner you invest, the more time your money has to grow. Sure, that logic holds water, assuming you've got the emotional fortitude of a Zen monk. When the market nosedives, it's easier to panic and sell, turning paper losses into real ones. But with DCA, your regular investments might just give you the confidence to stick with your plan. After all, a lower market means more shares for your buck. Let's put this into context. Remember the 2008 financial crisis? If you'd invested a lump sum at the beginning of that year, you'd have seen around half of it vanish by 2009. But If you'd been dollar cost averaging, you'd be buying more shares at lower prices, and when the market rebounded, you'd be sitting at a hefty profit. Now, you might be thinking, sure, DCA sounds great, but who has the discipline to keep investing regularly? Well, guess what? If you're contributing to a 401k or a similar retirement account, each pay period, you are already using dollar cost averaging. Every paycheck, a portion goes into your selected funds, regardless of their price. And over time, this can lead to substantial growth in your account. So, how can you start using DCA in your investment strategy? It's simple. Just decide on a fixed amount that you can afford to invest in each month. It could be $50, $100, $500, whatever fits your budget. Then, set up automatic transfers to your investment account. Most brokerages and investment platforms offer this feature. Remember, the goal here isn't to hit a jackpot overnight. It's about building wealth consistently over time. You're not trying to time the market. You're trying to accumulate assets slowly and surely. That's the essence of dollar cost averaging. Now, before we wrap up, it's important to note that while DCA can be a powerful strategy, it's not a magic bullet. It doesn't guarantee profits or protect against losses in declining markets. And like all investment strategies, it requires patience and discipline. But if you are someone who's looking to invest but is wary of market volatility, or if you're someone who doesn't want the stress of trying to time the market, dollar cost averaging could be a great strategy to consider. So there you have it, dollar cost averaging, the potentially easy way to build wealth over time. It's not flashy, it's not going to make you a millionaire overnight, but it might just make you a millionaire eventually.